Hello and welcome to our channel. If you are a returning viewer, welcome back. And if you're new here, please give us a like and show us support by subscribing to our channel. Thank you so much. Now, without further ado, let's get into the video.
Warren Buffett battled inflation in the late 1970s and early 1980s, and also observed the long-term effect consistent inflation has on consumer buying power, investments, savings, and companies' expenses. Here are his insights on both investing and personal finance during inflationary environments. Warren Buffett inflation advice. If we dropped $1 million of cash into every household in the United States today, everybody would feel good, except the people invested in things dominated in dollars. Warren Buffett. The worst thing he says you can hold during an inflationary environment is the currency that has its value being inflated away by too much supply of that currency. Savings, bonds, and low or no interest money market accounts are all hurt by a reduction in buying power. This is likely why we see Buffett put capital that has been on the sidelines to work in investments during inflationary environments. Buffett doesn't try to predict future inflation. He looks at the current inflation rate and trends and makes portfolio buying adjustments while sticking to his long-term value investing system. Unfortunately, most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they are compelled to put more and more dollars into the business just to stay in the same place. You know, the worst kind of business is one that makes you put more money on the table all the time and doesn't give you greater earnings. Warren Buffett. Buffett is explaining that companies with low returns on tangible assets have trouble with return on equity as they must keep rolling their profits back into the business, and it's difficult to have capital expenditures for upgrading equipment and investing in growth. These are companies that require large purchases of materials and inventory to operate, so they are capital intensive on the front end and at the mercy of their suppliers without pricing power at the first step in their production process. You want to avoid investing companies that don't have pricing power to pay for their increase in production cost and labor expense. If a company can't raise its prices with customers without decreasing their sales and volume, then they lower their profit margin percentage and decrease their overall profitability in dollar terms as their price and sales remain the same. Companies that can't pass along their own inflation in their costs to consumers can also go bankrupt if they don't have adequate capital or credit for extending loans to stay in business as their profits evaporate. Warren Buffett inflation hedge. I will say this about gold. If you took all the gold in the world, it would roughly make a cube 67 feet on a side. Now, for that the same cube of gold, it would be worth at today's market price about $7 trillion. That's probably about a third of the value of all the stocks in the United States. For $7 trillion, you could have all the farmland in the United States, you could have about 7 Exxon Mobiles, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, and you know me touching it and fondling it occasionally, call me crazy, but I will take the farmland and the Exxon Mobiles. Warren Buffett. While unproductive assets like gold, art, and real estate can hold their value during inflation as a hedge against a devaluing currency, they don't produce cash flow and don't have asset production value. Buffett prefers holding stocks of companies that produce commodities like oil and gold during recession as a hedge. He also bought and owned farmland when he was young that produced a harvest each season. He loves cash flowing assets above all other investment classes, especially in times of inflation, which shows from his recent gold mining and oil company purchases. So here are the types of companies Buffett suggests that will do the best during times of high inflation. Companies with low capital requirements and high return capital. Businesses with strong brands, high margins, and low capital requirements, like Buffett's holdings of Coca-Cola and See's Candy, for example. Also, successful software companies that are able to scale their products digitally with low operating costs, like Microsoft. Companies with pricing power that can increase their prices with the rate of inflation with no loss of customers or volume. They have a product or service people want or need consistently, regardless of its price. Companies that have little or no need for cash or continued new capital investments and room for leverage on their balance sheets. They have high cash flow, large cash reserves, and low debts. Apple is one of these types of companies. Warren Buffett inflation quote: "Inflation swindles almost everybody, and that it is extraordinary how much inflation had been seen in Berkshire Hathaway's own business." The best thing a person can do to protect against inflation was to sharpen their skills and focus on being at the top of their field. The best thing to do is invest in yourself. The best thing you can do is to be exceptionally good at something. Warren Buffett's best hedge against inflation is expertise in your chosen career or vocation. Whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. So the best investment by far is anything that develops yourself and it's not taxed at all. Inflation acts as a gigantic corporate tapeworm. That tapeworm preemptively consumes its requisite daily diet of investment dollars regardless of the health of the host organism. Regardless of a company's profit, it has to spend more on receivables, inventory, and fixed assets to simply equal the unit volume of the previous year. The arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislature. The inflation tax has a fantastic ability to simply consume capital. It makes no difference to a widow with her saving in a 5% passbook account whether she pays 100% income tax on her interest income during a period of zero inflation or pays no income taxes during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Any money she spends comes right out of capital. She would find outrageous a 120% income tax, but doesn't seem to notice that 5% inflation is the economic equivalent. We should all consider the impact of inflation on our own investments and life, as it can be the biggest expense over the long term.
That was today's video. Thank you so much for watching, and I hope you enjoyed it and that you learned something interesting. Comment down below what you liked the most about this video and suggest any topics that you would like to hear about in future videos. To show us support, please give us a like and subscribe to our channel, and I will see you in the next video.